Have you ever jumped into a trade only to watch the market instantly move against you, leaving you stunned, frustrated, and wondering if the universe had a personal grudge? If so, welcome to the club. Every new trader, whether in crypto, stocks, or Forex, falls into the same traps. And the cruel irony? These traps are obvious in hindsight, yet invisible in the moment. Let's get real. Trading isn't just charts and numbers, it's a psychological minefield. One wrong step and your account isn't just bleeding, it's gone. The market doesn't care how passionate you are, how many YouTube videos you've watched, or how right your analysis felt. It only cares about one thing: exploiting your mistakes. That's why so many beginners blow up before they ever get a chance to grow. They don't lose because they're stupid. They lose because they fall into traps designed to catch them. Traps set by the market, by shady groups, by hidden costs, and most of all, by their own impatience. In this series, we'll break down the 5 deadliest traps new traders face across all markets: crypto, stocks, and Forex. We'll uncover why people keep stepping into them, how the market uses psychology to lure you in, and most importantly, how to escape before it's too late. So buckle up, because the first trap is one that has wiped out more Forex traders than any technical pattern ever has: trading before major news events without checking the economic calendar. Trap 1. Trading before major news events. There's an old saying among professional traders: amateurs open positions before the news. Professionals close them. If you've ever blown up during an FOMC meeting, an interest rate announcement, or even a surprise jobs report, you know exactly why this is trap number 1. Let me paint the picture. You've been staring at euro to US dollar all morning. The chart looks clean, a breakout is forming, your RSI lines up, your moving average crossover looks beautiful, and you convince yourself this is it. Perfect setup. You enter. 2 minutes later, a Fed announcement drops. The candle doesn't move, it explodes. 1 second you're green, the next second you're staring at a giant red bar that eats your stop loss in a single gulp. This isn't bad luck. This is negligence. Because every trader with a shred of experience knows, news moves. Markets faster than any pattern ever will. The economic calendar is not optional. It's survival. The Federal Reserve, ECB, Bank of Japan, employment data, inflation reports, these aren't just events. They're grenades. If you're standing on the chart when they go off, you get blown up. The psychology behind this trap is simple: impatience and overconfidence. New traders don't want to wait. They see a setup forming and think, I don't care if there's news. The chart looks good. That's like ignoring storm warnings, because the sky looks clear right now. The storm doesn't care about your analysis. It's coming. And here's the paradox. Sometimes your setup is right. Maybe euro to US dollar really was about to break out. But news events don't just move price, they whip it. Spreads widen, slippage hits, volatility turns clean patterns into chaos. The chart you trusted gets shredded, and your account along with it. Professionals know this. That's why many won't touch the market 30 minutes before and after a major announcement. They'd rather miss a move than risk getting shredded by whipsaw candles. In fact, some pros use news only as spectators. They study how markets react, but they don't bet. They know news is unpredictable, and unpredictability is poison to consistent trading. But let's get sarcastic for a second. How many times have you told yourself, I'll just scalp quick before the Fed speaks? That's like saying, I'll just play tag on the freeway before rush hour. You might survive once or twice, but sooner or later, you're roadkill. And it's not just Forex. Stock traders fall for this during earnings season all the time. They hold positions overnight, ignoring the fact that earnings reports are basically coin flips. One word from a CEO can erase months of gains in seconds. Crypto traders? Same thing. They ignore scheduled events like ETF approval votes or regulatory announcements. The market doesn't drift when news hits. It detonates. So how do you avoid this trap? Step 1. Build the habit of checking the calendar daily. Make it part of your routine, like brushing your teeth. Before you trade, ask, what's scheduled today? What could move the market? If you see red flags like FOMC, non-farm payrolls, CPI, or a central bank speech, either scale down massively or stay out. Step 2. Define your personal news buffer. Many traders avoid trading at least 30 minutes before and after news. Some extend it to an hour. The point is to give volatility time to settle so your edge isn't wiped out by random spikes. Step 3. If you must trade news, treat it as gambling. Don't fool yourself into thinking you're analyzing the outcome. News moves on interpretation, not just the numbers. A report can come out positive, yet markets tank because traders expected better. You can't predict that. If you insist on trading it, size down and accept it's not skill, it's luck. Step 4. Use news to frame context, not predict moves. Instead of trying to guess direction, study how different pairs or stocks react historically. Maybe USD/JPY tends to spike one way, then reverse. Maybe gold becomes untradeable for hours. Knowing behavior helps you avoid traps, even if you don't trade it. The real lesson? The market is ruthless, but it isn't random. News events are scheduled. They're public. If you lose money because you ignored them, that's not bad luck. It's bad discipline. And this discipline is what separates amateurs from survivors. The amateur treats the calendar like a suggestion. The professional treats it like a rule book. Which one do you want to be? So, next time you feel the itch to enter right before a Fed announcement, ask yourself, am I trading the chart or am I trading my impatience? Because one will keep you alive. The other will make sure your account doesn't live to see tomorrow. And speaking of traps, the next one is unique to crypto, but its psychology applies everywhere. It's the infamous bear trap. When you think the floor just collapsed, you short aggressively, and then price reverses upward, leaving you crushed. Trap 2. Bear traps in crypto. There's a special kind of pain reserved for traders who fall into bear traps. You know the feeling. The chart looks like it's collapsing. The breakdown seems obvious. You short aggressively, and then, almost instantly, price reverses, shoots upward, and you're left scrambling to cover in panic. Your genius short turns into a forced buy at the worst possible price. Welcome to the bear trap. Crypto altcoins are notorious for this. One moment, they're breaking support with conviction, volumes spike, panic spreads, and everyone rushes to short. But here's the twist. That breakdown was staged. Big players lure you in, force liquidations, and then reverse the market violently upward. Suddenly, you're not just wrong. You're fuel for their rally. Why does this trap work so well? Because it preys on fear. Humans are hardwired to run when they sense danger. On a chart, danger looks like a red candle slicing through support. The amateur brain screams, "Get in now! Don't miss the collapse." But what you're really doing is joining the stampede, right before it runs off a cliff. Here's the irony. Professionals love bear traps. Not because they fall for them, but because they use them. When retail traders panic sell into a fake breakdown, pros scoop up those cheap coins or shares, pushing price higher while shorts scramble to cover. It's not manipulation, it's strategy. They understand the psychology of the crowd, and they weaponize it. Let me give you a classic example. Bitcoin has a long history of fake breakdowns around round numbers. $30,000, $20,000, $10,000. Every time price dips just below those levels, retail traders scream, "It's over," and short heavily. Minutes later, the price rips back above the level, trapping them. The short covering adds fuel, turning the fake breakdown into a breakout. The losers, retail, the winners, the patient players who waited for panic to peak. And this isn't just crypto. Stocks do it too. A company dips below a critical support, retail piles in short, only for an institution to buy aggressively. Suddenly, price rips back, and shorts are squeezed. Forex pairs can trap traders the same way around psychological levels, EUR USD breaking below 1.0500, only to bounce right back, punishing shorts. Different markets, same psychology. So how do you avoid this trap? First, awareness. If something looks too obvious, it probably is. Markets rarely hand out free money. If everyone on Twitter is screaming breakdown, That's usually your signal to wait, not jump. Second, study volume and follow through. A true breakdown should see volume surge and sustain. If price breaks support, but volume fades quickly, be suspicious. Weak conviction often signals a trap. Third, wait for confirmation. Don't short the instant price pokes below support. Give it time. See if it retests the level and fails again. Bear traps often reverse violently, so waiting for confirmation can save your account and your sanity. Fourth, manage size. If you insist on trading breakdowns, don't load the boat. Small positions mean small losses when you're wrong, and trust me, you will be wrong sometimes. But let's get blunt. The real issue isn't technical, it's emotional. Traders fall into bear traps because they can't resist the thrill of catching the big collapse. It feels powerful to be right as a market crashes. It strokes the ego, but that same ego is what makes you easy prey. Think of it this way. In every bear trap, there are two types of traders, the hunters and the hunted. The hunted react to fear, the hunters anticipate it. Which one do you want to be? So next time you see that juicy breakdown, ask yourself, is this a genuine move, or is it bait? Is the market really collapsing, or are the big players just fishing for liquidity? Because if you're wrong, you're not just losing. You're fueling the rally that humiliates you. And this brings us to the next trap, one that's not about emotions, but about hidden costs. Because even if you manage to dodge bear traps, there's another slow bleed that eats traders alive, ignoring swap fees in Forex and gas fees in crypto. These invisible killers don't wipe you out in a single trade. They drain you quietly until you wake up and realize your profitable strategy isn't profitable at all. Trap 3. Ignoring swap fees or gas costs. Most new traders obsess over entry points, indicators, and chart patterns, but they forget one of the most boring, unsexy details of trading: fees. And ironically, fees are what kill many accounts, not the charts. In Forex, it's the overnight swap fee. In crypto, it's the dreaded gas fee. They don't blow you up in one spectacular explosion like news events or leverage. They drain you slowly like a leaky pipe flooding your house while you sleep. Let's start with Forex. You hold a position overnight, maybe for days, thinking, I'm swing trading, like the pros. What you forget is that every night your broker is quietly charging you a swap rate. Sometimes it's tiny, fractions of a percent. But stack that over weeks and months, it eats away at your profits like termites in a wooden house. And here's the kicker. Depending on the interest rate differentials of the currencies you're trading, you might actually pay to hold a trade you thought was safe. Imagine this. You enter a long euro to US dollar trade. You hold it for 3 weeks. The price barely moves. You close at break even, or so you think. Then you check your account and realize you're down hundreds of dollars. Not from the chart, from the swap fees that piled up every night. That's not trading. That's bleeding to death slowly. Now let's talk crypto. Gas fees are even more devious. You might see them as just transaction costs. But if you're moving tokens frequently or holding positions in DeFi platforms, those fees stack up fast. During peak Ethereum congestion, gas fees can be $50, $100, even more per transaction. Think about that. You're trying to scalp small profits, but each trade costs you as much as a fancy dinner. By the time you add it all up, your account balance looks like you've been robbed, because you have, just quietly, one transaction at a time. Why do traders fall for this trap? Because fees feel invisible. They're not dramatic red candles on your chart. They don't scream at you like a margin call. They whisper. They hide in the background. And because they're small at first, you ignore them. But small leaks sink big ships. And here's the psychological twist. New traders are often so obsessed with being right about direction that they never stop to ask, is this trade even worth the cost of holding? Pros think differently. They calculate the cost of carry before they ever enter. They know which pairs have positive swaps, and they design strategies to benefit from them instead of suffer. Some even build entire systems around collecting positive swap interest while price drifts in their favor. That's not luck. It's awareness. Crypto pros do the same. They don't chase every shiny token. They factor in gas fees before moving funds. They use layer 2 solutions or lower cost chains. They track their real cost basis, not just entry price. Amateurs only look at charts. Pros look at charts and the fine print. Let me give you a blunt metaphor. Ignoring fees is like running a marathon but tying 10-pound weights to your ankles. You might still cross the finish line, but you'll be exhausted, slower, and far more likely to quit. Why handicap yourself? So how do you protect yourself from the hidden cost trap? Step 1. Always check the swap rate before entering a Forex trade. If you're planning to hold overnight, know whether you're paying or earning. If the swap is heavily negative, reconsider. Is the setup worth bleeding money every night? Step 2. Track your holding costs over time. Don't just celebrate a profitable trade, subtract the fees from your P&L. You might be surprised how much of your profitability is illusion. Step 3. In crypto, be strategic with timing. Don't move funds around constantly when gas fees are high. Wait for off-peak hours. Use blockchains with lower fees when possible. Optimize, don't just click. Step 4. Think long-term. Fees punish overtrading and sloppy planning. They reward patience and precision. The less you churn your account, the less you bleed. But let's get motivational for a moment. Trading isn't about perfection. It's about survival. And survival means respecting every single detail that can drain you. If you ignore fees, you're not being a professional trader. You're being the casino's favorite customer. And that's the sarcastic irony. Many new traders think they're losing because their strategy doesn't work. In reality, the strategy might be fine, but the leaks in the boat, swap, gas, commissions, are sinking them faster than any red candle ever could. So next time you click buy or sell, ask yourself, am I trading the chart or am I trading against my own broker's fee structure? Because the chart might let you survive, the fees won't. And this brings us to another deadly trap, one not hidden in the fine print, but blasted across social media every day, blindly following signals from untrustworthy groups. If you think your Telegram guru is going to make you rich, you're in for a painful awakening. Trap 4. Following signals from untrustworthy groups in stock day trading. There's a universal fantasy in trading that somewhere out there is a magic guru, a secret group, or a Telegram channel with the holy grail of signals. You imagine logging in, copying trades, and raking in profits while sipping coffee. Easy money, right? Wrong. That fantasy is one of the most dangerous traps in the markets. Following signals from untrustworthy groups doesn't just hurt your account, it destroys your independence. And here's the cruel joke. Most of those groups aren't designed to make you money. They're designed to make them money. Let's break this down. Why do so many beginners fall for the signal trap? Psychology again. Trading is lonely, stressful, uncertain. New traders crave certainty. They want someone to tell them what to do so they don't feel the weight of responsibility. Signals feel safe. Someone smarter already did the work. But that's exactly the lie. Think about it. If someone had a guaranteed winning strategy, why would they sell it for $50 a month? Why would they run a Telegram channel instead of quietly compounding millions? The truth is, many signal sellers profit more from subscriptions than from trading. You're not their student, you're their customer. And when the signals fail, which they will, you're left holding the losses while they pocket the fees. And it gets worse. Some shady groups deliberately manipulate markets. In low-volume stocks or altcoins, they'll pump the price, blast a buy signal to their followers, and then dump their own holdings onto the crowd. By the time you enter, they're already exiting. Congratulations, you just became their liquidity. Stock day trading groups are notorious for this. They lure beginners with screenshots of massive wins, cherry-picked trades, and fake testimonials. Meanwhile, most followers lose consistently. Why? Because they don't understand the trades they're copying. They're not managing risk. They're not using position sizing. They're not thinking for themselves. They're just clicking buy when told. That's not trading. It's dependency. Let's get sarcastic for a second. Imagine a surgeon walking into the operating room, pulling up a Telegram chat and saying, "Okay, guys, what should I cut next?" You'd never trust that surgeon. Yet traders trust strangers with their life savings because a chat room said, "Buy now." Here's the real danger. Signals rob you of growth. When you follow blindly, you avoid the discomfort of decision making. And it's in that discomfort where the real lessons live. Every loss you take on your own terms teaches you. Every win builds confidence. But when you outsource decisions, you outsource learning. You stay stuck. And the moment the group vanishes or turns out to be a scam, you're left with nothing but losses and regret. So what's the solution? First, take responsibility. No one is coming to save you. If you want to survive in trading, you must become your own authority. That doesn't mean you can't learn from others. It means you process what you learn, test it, adapt it, and make it yours. Extract principles, not prescriptions. Second, verify everything. If you're tempted by a group, track their signals without trading them. Journal the results. Most of the time, you'll find their 90% win rate is marketing fiction. Third, focus on education, not shortcuts. Signals are fast food, cheap, addictive, and unhealthy. Real trading is like cooking your own meals. It takes effort, but you control the ingredients. You know what you're consuming, and over time, you become self-sufficient. Let me give you a story. A trader joined a stock signal group with hundreds of followers. At first, it felt amazing, green trades everywhere, but soon, losses mounted. He realized the group leader was front-running signals, buying first, then alerting followers, then selling into their entries. The followers lost, while the leader profited. When he finally quit, he felt betrayed. But the real betrayal wasn't the group. It was his own decision to give away control. And that's the core truth. Signals aren't the trap. Your desire for certainty is the trap. The market doesn't reward people who outsource responsibility. It rewards people who take it. So ask yourself, do you want to be a follower, forever dependent on someone else's calls? Or do you want to be a trader, independent, resilient, self-reliant? Because every time you click buy on someone else's signal without understanding it, you're not just risking money, you're risking your identity. And speaking of identity, there's one final trap that ties everything together. You can dodge news events, avoid bear traps, manage fees, and ignore shady signals. But none of it matters if you make the ultimate mistake, putting all your money into one basket. Because when that basket drops, so does your future. Trap 5. The diversification trap, betting it all on one asset. If there's one trap that has humbled traders in every market, crypto, stocks, Forex, it's the refusal to diversify. The all-in mentality. The gambler's dream that one coin, one stock, one pair will make you rich forever. Spoiler alert, it won't. In fact, it's more likely to wipe you out. Let's be clear. Concentration can make you money quickly, but it can also destroy you just as fast. New traders often fall in love with a single asset. They pile their entire account into one crypto token, one meme stock, or one safe currency pair. They justify it with conviction. This is the next Bitcoin, or this company is the future, or EUR/USD is stable, I'll be fine. But the market doesn't care about your conviction. It doesn't care about your research. It doesn't care about your feelings. And when that one asset tanks, your portfolio tanks with it. Crypto is the most brutal example. How many traders went all in on Luna, FTT, or any other blue-chip token, only to see it implode overnight? Billions vanished, lives destroyed, and the worst part? Many of them knew better. They told themselves they were diversified, but in reality, 90% of their portfolio was sitting in one token. When that token collapsed, so did their accounts. Stocks are no kinder. Remember the meme stock mania? AMC, GameStop, Bed Bath & Beyond, people bet their life savings on these tickers. For a while, it worked. Social media screamed to the moon, and portfolios ballooned. But when the hype faded, reality returned. Those who diversified survived. Those who didn't? They're still holding bags that may never recover. Forex traders aren't immune either. They convince themselves they're diversified by trading multiple pairs. But here's the catch. If all those pairs are tied to the same currency, they're not diversified at all. You might be trading euro dollar, pound dollar, and Australian dollar, but guess what? You're really just betting against the dollar 3 times over. That's not diversification. That's tripling your risk. Why do traders fall for this trap? Ego and greed. Going all in feels powerful. It feels bold. It feels like conviction. Diversification, on the other hand, feels boring. It feels slow. It feels like you're watering down your returns. And let's be honest, everyone dreams of the glory story, the trader who put everything into one trade and became a millionaire overnight. But here's the truth. For every glory story, there are thousands of untold tragedies. The people who went all in and lost everything. Professionals understand this. They know survival is more important than excitement. They spread risk across assets, across sectors, across strategies. They may not double their accounts in a week, but they also don't lose them in a day. And that's why they last. Here's the sarcastic irony. Many new traders spend hours researching technical setups, indicators, and strategies, yet they ignore the simplest principle of risk management. Don't put all your eggs in one basket. That's not advanced trading theory. That's kindergarten wisdom. And yet, time and again, traders ignore it, thinking they're smarter, braver, or luckier than everyone else. So how do you escape this trap? Step 1. Be honest about your exposure. Don't just count how many assets you own. Look at how correlated they are. If all your trades rely on one outcome, like the dollar falling or one token pumping, you're not diversified. You're gambling. Step 2. Adopt position sizing rules. Many pros risk no more than 5 to 10% of their portfolio on any single idea. That way, even if one blows up, they live to fight another day. Step 3. Balance short-term and long-term plays. Don't lock all your capital in speculative bets. Mix in safer, boring assets that protect your downside while you chase opportunity with a smaller slice. Step 4. Accept that diversification will cap your upside. Yes, you won't become rich overnight, but you also won't go broke overnight. And in trading, staying alive long enough to learn is the only path to real wealth. Let me tell you a story. A trader once bragged to me that he put 100% of his capital into a single altcoin. It tripled in a month. He thought he was a genius. He refused to diversify, convinced he found the golden ticket. A few weeks later, the project collapsed. He lost everything. His story ended there. Meanwhile, another trader spread capital across multiple assets. Some winners, some losers. He didn't look like a genius in the short term, but he's still trading today. And that's the difference. Trading isn't about glory, it's about survival. Diversification is survival. It's boring, it's slow, it's unsexy, but it's what keeps you in the game when everyone else is getting carried out. So the next time you feel the urge to go all in, ask yourself, do I want to be the hero of a short story or the author of a long career? Because the market loves killing heroes, but it respects survivors. And now it's time to bring everything together. We've covered news events, bear traps, hidden fees, signals, and diversification. Each trap looks different, but they all share one theme. They prey on psychology. In the final part, we'll connect the dots and uncover the bigger lesson. Why trading isn't just about beating the market, but about transforming yourself. The grand summary and transformation. By now, the pattern should be obvious. The traps that destroy traders aren't just about charts, patterns, or technicals. They're about psychology. Every single mistake we've explored, trading before news, falling into bear. Traps, ignoring fees, following shady signals, and betting it all on one asset, comes back to one root cause: the human mind. The market doesn't kill your account. You do. The market doesn't force you to hold through a Fed announcement. It was your impatience. The market doesn't drag you into a fake breakdown. You jumped because of fear. The market doesn't charge you hidden fees. You ignored them out of laziness. The market doesn't force you to follow a Telegram guru. You gave away your responsibility. The market doesn't tell you to go all in. You let greed dress itself up as conviction. And that's the brutal, liberating truth. If you are the cause, then you are also the cure. Professionals don't succeed because they're smarter, luckier, or chosen. They succeed because they build habits that protect them from themselves. They check calendars before trades. They wait for confirmation instead of chasing panic. They factor in costs before entering. They learn principles, not just signals. They diversify so one mistake doesn't erase their future. And most importantly, they own their decisions. Every trade is theirs, win or lose. Here's the paradox. New traders want freedom, but they trade like prisoners, enslaved to emotions, signals, and hype. Real freedom comes from discipline. Discipline sounds boring, but it's what turns chaos into consistency. Think of trading like survival training. The amateurs rush in with bravado and get eaten alive. The professionals move slower, but they last. And in the markets, longevity is everything. Because wealth doesn't come from one lucky trade. It comes from thousands of trades, compounded over years, managed with boring discipline. Let's get blunt. If you're still looking for shortcuts, you'll be stuck forever. There's no guru, no signal, no magical coin that will save you. The only edge is the one you build inside yourself. Your patience, your risk control, your ability to stay calm when others panic, your willingness to learn when others quit. So, let's recap the 5 traps. Trap 1. Trading before major news events. Lesson: respect the calendar or the calendar will wreck you. Trap 2. Bear traps. Lesson: if it looks too obvious, it's bait. Wait, confirm, survive. Trap 3. Ignoring fees. Lesson: small leaks sink big ships. Count every cost. Trap 4. Blindly following signals. Lesson: outsourcing responsibility means outsourcing growth. Own your trades. Trap 5. Neglecting diversification. Lesson: don't try to be a hero. Diversify so you can stay alive long enough to win. Now the question is, which trader do you want to be? The one who keeps falling into these traps, blaming the market, blaming brokers, blaming gurus, or the one who accepts the truth, takes responsibility, and transforms? Because here's the final insight. Trading isn't about predicting markets. It's about predicting yourself, knowing your weaknesses, planning for them, and refusing to let them control you. When you master yourself, the traps lose their power. And that's the trader the market cannot destroy. So next time you sit down at your screen, ask yourself, am I about to fall into a trap, or am I about to step around it? That single choice, repeated over and over, determines whether you'll join the 95% who fail or the 5% who survive. Remember, your next trade isn't just a position, it's a decision about who you're becoming. Choose wisely.